I'm David Marcus, senior writer at The Deal, with Andy West, a director at McKinsey and leader of its M&A practice. Andy, thanks for joining us today.
Great to be here.
What are we seeing in the M&A market right now?
Well, M&A continues to be pretty robust. If you recall back to our conversations at the Deal Economy in 2014, everyone was looking positively at 2015 after big gains between 2013 and 2014, and deal activity stayed high. Off of a big jump up in 2014, we've seen upper mid-single digit growth globally in M&A activity.
And are there any aspects of the growth this year that are particularly noteworthy?
Yeah, I think there are. I mean, one, it continues to be very much a U.S. phenomenon. U.S. now represents over 55% of total deal activity, which is an even bigger spread than last year. I think that's driven by a lot of large deal activity, which is also unique. It's almost 60% of all of U.S. deal activity. That's interesting, as large deals tend to underperform. You see that being driven in the healthcare sector largely, which has got some, I think, pretty good fundamentals around large-scale M&A. But it's very unique. I think Europe continues to be recovering from an M&A point of view. They dropped about 50% in terms of total activity between 2007 and 2008. And you continue to see that recovering, but it's still about 40% less than U.S. activity. In Asia, actually, Asia's up. China is up almost 3x from 2012 in terms of deal activity, which is driven by a lot of inter-China action. So big differences in terms of the way different regions are approaching M&A.
And you talked in the U.S. about activity being driven by mega deals. Investors seem to be rewarding those deals. Why are investors rewarding those deals now? And what's driving some of those companies, especially in healthcare, to do those transactions?
Yeah, we do an analysis called deal value add, which basically looks at the announcement effect of a deal. So 2 days before and 2 days after a deal is announced, we look at the stock movement. We control for cash and other distributions that might affect the value. That, as we reported last year, is at an all-time high in aggregate. When you look at large deals, last year, for the first time ever, our deal value add index was positive for the acquiring company. Always the acquirer has a deal, the acquiree has a deal premium associated with it, meaning they're getting 30-40% on top of their actual value. So that stock price always jumps. But last year, for the first time ever, acquirers on average jumped, and this year they've jumped even more. So yes, the market is very, very positive on a lot of these acquisitions. In healthcare, I think there are a few things that are driving it. I mean, first, there is still a lot of M&A activity. You know, the sector itself is still relatively fragmented. You've got some large companies at the top, obviously, but there's a lot of medium cap and small cap companies still in high tech or in med tech and pharma. You see a lot of different strategies still being viable. So there is a lot of cost takeout that's being done, and a lot probably still to be done as the sector consolidates. You see people looking for growth. And there's a lot of R&D that's happening in the space that companies are acquiring. So there are a variety of variables that, you know, regardless of your strategy, would drive activity in that space. I think also you have a lot of divestiture activity. As you see some of the larger deals, if you think about Becton Dickinson and CareFusion, for example, they have assets that they need to spin. And when we look at M&A activity, it's also driven by divestitures. And so some of these large deals are actually creating additional deal activity as companies spin off assets as regulated or as demanded by shareholders.
And as you look at these mega transactions, when you work with clients, are there things that you try and help focus them on to improve their returns from those sorts of deals?
Yeah, we talked a little bit about this last year as well. When we look at overall M&A strategies, large deals tend to underperform pretty significantly relative to a strategy that is focused on doing lots of maybe smaller deals over a longer period of time. And the reason is just internal focus. And so when we talk to our clients, we want to make sure that if they're doing a large deal, they're really thinking about the integration. They're really thinking and taking very seriously all of the effort required to make that happen. It takes multiple years. It's very distracting in terms of what's happening in the marketplace. So you have to stay externally focused. And you just have to have the tenacity and the focus just to really go after that value over a multiple year period. So the story remains to be seen. As we look at some of our emerging data, more recent data on large deal performance, we are seeing an uptick in performance. So I think companies may be getting better at large deals, but you know, the value for these deals takes 2 to 5 years to actually manifest itself in share price movement, so we'll have to see.
Andy, thanks for joining us.
Glad to be here.
With Andy West, I'm David Marcus for The Deal.